I will just speak briefly about a few logistical items before we get started with today's presentation. First, you should be able to view our presentation through the Zoom Webinar Tools window on your desktop if you've joined us by computer. Next, you will see a chat function on the Zoom window's black toolbar. Please click on that chat button and use that function to type in any questions you may have throughout the presentation. I will administer a question and answer session following our discussion based on the questions that are typed into that chat window. We are recording today's webinar, so you can refer back to the information presented today at a later time. I will send an email containing a link to that recording shortly after this webinar concludes. In addition, that email will contain a very short 2-minute survey that gives you a chance to tell us what you think of today's webinar. So please do be on the lookout for that email with the link to the recording, and do take a couple of minutes to give us feedback on this presentation. Now I am pleased to introduce Philip Henry from Fifth Third Bank, who's going to share a bit about the bank's commitment to community before we get started. Thanks so much for being with us, Philip.
Thank you, Meredith. Good afternoon. I'm Philip Henry, Community and Economic Development Program Officer for Fifth Third Bank. And once again, thank you for joining today's webinar, Build or Maintain Good Credit After Crises, our third small business webinar of 2020 in partnership with Accion. Also, thank you for allowing us to support you through these difficult times. We are on this journey together, and we can collectively be a part of the positive change that our country so desperately needs. Our commitment to put business customers at the center of everything we do is a driving force behind our ongoing collaboration and partnership with Accion. Together, we share a common goal, and that's helping entrepreneurs overcome barriers and achieve business growth by expanding access to capital and educational resources. Fifth Third Bank, in collaboration with the National Community Reinvestment Coalition, made a commitment to invest $32 billion in the communities that we serve through 2020. The plan was originally announced as a $27.5 billion commitment in February of 2016. It expanded to $30 billion in November of 2016 and expanded once again in October 2018 to $32 billion. To reflect Fifth Third's expansion into the greater Chicago area. We are making great progress on that commitment with significant help and engagement with community and business partner organizations such as Accion. As you can see from the slide, we have almost completed the 5-year plan with $31.2 billion in lending and investments to improve lives in low and moderate income communities throughout our 10-state footprint. We have committed $13.1 billion in mortgage lending, $8.2 billion in small business lending, and $8.7 billion in community development lending and investments. As you can see, Fifth Third Bank is committed to all of the markets that we serve. Several hundred entrepreneurs have been helped through our support of economic development programs, including technical assistance and micro-lending for small businesses through partners like Accion. If you're launching your business or expanding it, our team at Fifth Third and our resources are available to you every step of the way. Please visit our Business Resource Center at 53.com and let us help you meet your financial goals and assist you with smart financial solutions for both your personal and business needs. Thank you, and back to you, Meredith.
Thanks so much, Philip. We really appreciate this partnership with Fifth Third Bank and all you all do for the community. So now we will turn over to our discussion on credit. As you can see here, we've got 2 experts with us today who are really going to be super helpful in leading us through this discussion. First, my colleague Rowan Richards, who's a Director of Coaching and Connections for Accion's Chicago office, and Jack Moore, who is a Business Banking Credit Officer at Fifth Third Bank. We're really happy to have you both with us today. Thank you so much for joining. So now we are going to dive on into our first discussion point. Jack, thanks so much for being with us. Can you talk us through some of these first steps a business owner should take when it comes to credit?
Sure. Having an understanding of your credit score is important because it's a factor as far as lenders determining what they will do. There's three bullet points as part of the presentation there, as far as understanding your credit score and checking it, understanding business and personal credit, and then finding out the lender's criteria is the third one. I'll actually start with that one and work up from there. And the reason why is lender's criteria can change in depending on the size of transaction that they're underwriting, and it can change from the lending institution that you're working with. I'll give you a couple of examples. Uh, the smaller the transaction, there's a greater reliance usually placed upon your credit score and the expectation that as a guarantor that you are one of the primary sources of repayment. In general, lenders look at three sources of repayment when they're looking at lending money. One is from the cash flow of the business. Second is the collateral that they may be taking in the transaction. And then third, the guarantor of the transaction, usually the owner or owners of the transaction. So three possible sources of repayment. Most important is the cash flow from the business, possibly collateral as a secondary source, and then third is the guarantor. The smaller the business, the more intertwined the individual owner and guarantor is with the business, and they almost become one source of repayment. The larger the business, more likely the business is large enough that the importance of the guarantor may not become as important because the size of the business becomes so much larger and has a lot of assets itself. So that's why when you talk about criteria, a lot of banks might have a sliding scale as far as how they underwrite transactions, where small transactions, it's highly driven by the credit score of the individual guarantor, the owner of the business. And the larger the transaction, it might be driven much more about the cash flow of the business, the assets of the business, and the balance sheet of the strength of the business. Each lender could be different. It's not standard for every financial institution as far as what criteria they might use at different dollar amounts or for different size businesses. So asking that question to your lender is an important one, whether it's bank or a non-bank, like a fintech type of lending operation, to understand the criteria that they use. And then working up as far as your credit score and the impact it plays in that. Your credit score is a driver as far as your credit worthiness, and it helps the bank determine how you have paid your creditors in the past. Obviously, the higher the score, it has a positive impact. The lower the score, it has a negative impact. Be aware that there's three different credit agencies out there: bureaus, a reporting agency, Equifax, Experian, TransUnion. Their information could vary a little bit between each bureau. Checking each bureau and understanding what your score is, you can check those once a year annually to get information about that, making sure that there's accurate information on the report, and you can make a file, a statement as far as to address something that is not, that should not be in your report, that can be addressed. But in general, the scale slides as far as the criteria. Understand, ask questions from who your lender is as far as what criteria they use, and then monitoring your score. Generally, each lender, the score will be different what they're looking for. Some could be it could be low as 650. Some it could be as high as 700 or 720, and the score could impact the rate that you are charged in the transaction. Once a year check it. A lot of credit card companies right now, they might offer you the ability to see what your score is each month with your statement. Those are what we would call a soft pull. That's not a hard pull in your credit report that's recorded that affects it in any way. It's just what is in a repository is what the score will be. So those are some very general information in that area, Meredith.
All right, thank you, Jack. I think there's a lot of really good points to think through there as far as having that conversation with your lender. It sounds like it's probably the most important place to start, would you say?
Yes, I would agree.
Awesome. All righty. So next we'll turn to the next step in building or maintaining credit with my colleague Rowan Richards. Rowan, once a business owner has learned some of those basics, how should she assess available credit options?
Yes, Meredith. And I think those were fantastic steps, right? I think that understanding that process is so important. It really does help with some of these next steps for any sort of business owner. And I like to recommend that the business owner would actually start with evaluating their use of capital. Before we even start exploring what those options are, really start thinking through what's that use of capital that I'm seeking these dollars for. And it could be, for a build out project, for some sort of asset acquisition, looking at payroll needs, or even just thinking about just the cost of customer acquisition, right? Think through these and it definitely is having those conversations.
Oh, Rowan, it looks like we have a bad audio connection, and the internet might have cut off. Let's see. Are you reconnected, Rowan? Can you hear us?
I think I'm back in. So
There
sorry.
you go. All right, reconnected. Thank you. I
Yeah.
think we lost you when you were talking about assessing the different ways to use the capital and
Yep.
thinking through how that might be helpful.
Absolutely. So once you start thinking about the use, then it's really about now looking at options and start with where you already have a relationship. So think about your bank or your other lending organization and having those conversations, identifying what sorts of products, sorts of lending tools do they have available to business owners. And then there's also some online resources. You want to make sure you're using a trusted resource. For us here in Chicago, through partnership with other microlenders and through the city of Chicago, we have something called Connect to Capital, which identifies vetted sources of lending that business owners can trust. So using those online tools, using your existing relationships, then looking at which ones are available to me, and then also which ones are the best fit for the specific things that I'm looking to do. So, if you have a piece of equipment that you're looking to purchase, for us, we direct our business owners towards some sort of one of our term loans, as opposed to somebody who, perhaps a contractor who just needs some capital to purchase supplies in order to complete a portion of a job before they receive payment. In those cases, perhaps a line of credit is a better option. So, coming in with an idea of what you're looking to use, and then having the conversation with a trusted lender, and who can then help further explore what's the best fit for actual program and dollar amount.
Great. I think that leads in perfectly. Oh, Jack, you want to join?
Yeah, I was, if you don't mind,
Oh, of course.
Rowan, I think what you said there was great. And to add some more detail to it, like you're saying, you're talking about a term loan there. We like to use the term a lot of time in the banking business, matching. Matching like you were saying, the purpose of the funds to the use of what they will be used for in the life of that asset. So as you're saying, if you're buying a piece of equipment and you think you'll depreciate it over 5 years, it might last longer than that, but that's what you're going to depreciate it over as far as the life. Hey, look at a term loan over 5 years. That way the asset should be paid for over its useful life. It continues to last past there. That's true. Real estate, obviously, we would finance that for a longer period of time. And then the lines of credit or credit cards, as you talked about, are for very short-term working capital. Hey, I just need this until to buy this material until I make something with it in just a couple of weeks. And hopefully, it won't be long after that I get paid, within a 30-day billing cycle, et cetera. You have anything to add to that, Rowan?
That's great. Thank you for adding on to what I was saying. That's I think for a business owner, anytime you can get that sort of clarity on, what should I be seeking, and what you just shared provides a business owner with additional understanding of even the timing of when to approach a lending organization uh, based on what's going on with their business.
Oh, Rowan, it looks like you're cutting out just a little bit again there. This working from home, we all have different internet connections, but I'm sure we'll get you back in here just a second. Can you hear us okay?
You hear me now, Meredith?
There you go. All right, perfect. All right, so this leads great into our next discussion point. I think you both, Jack and Rowan, addressed this a bit on being strategic with your timing or what the product is. But anything else to add about the strategy for taking on debt?
Yeah, I mean, when you're thinking about strategy and timing, obviously, one of the things that we try to work with many of our business owners who are either first-time borrowers or now looking to take, their, capital in amounts larger than they've had in the past. We always encourage you to make sure that you have a very specific purpose for these loans, right? So we want to be able to translate a loan into a revenue generating opportunity as your first layer of evaluation and part of the strategy on kind of the when and even the dollar amount. What we want to make sure is that we are doing everything possible to help a business owner actually improve their credit history, credit score, build those banking relationships either currently or in the future, right? So part of our role as a micro lender is and always will be to both provide access to immediate capital, but also help prepare that business owner for future success. It's very important in access to debt. Actually, it's a wonderful way of actually developing both, right? There's those immediate opportunities, but also setting your business up for future opportunities. So we want to make sure that we're doing everything possible to educate business owners to understanding how applying for credit is going to impact their credit score, how that's going to look either favorably or unfavorably to future lenders, and also to other forms of credit, right, from suppliers when they're looking for moving into different space and requiring a location or leasing a location, how it can impact all of those areas of their business. And as part of our process, we do work to help set expectations from the very beginning. We feel that it's helpful from both building that relationship with the business owner, but also for helping them start building towards that opportunity as quickly as possible. So for instance, if there's a business owner whose credit is not necessarily that strong and doesn't seem like they're going to be a great fit for a loan now, we want to identify that right away, but also provide the business owners with action steps on what they can do now so that maybe it's 6 months, maybe it's 9 months, 12 months down the road, they'll be in better position to actually apply and secure capital.
Right, I think that makes a lot of sense. It's not just a no, it's a no, but here's more resources.
Absolutely.
Great. All right. So next, Jack, I know this is something that's been talked about a lot, especially in sort of the wake of PPP, but these strong relationships with banks, what can you share about those relationships for business owners?
I think that's very important. As a small business, you want to surround yourself with experts, a CPA, an attorney, someone as far as centers of influence in your community that can assist your business. But a banker would be another one of those individuals that can assist you as well. As Rowan was saying, it's sometimes you might get a no to a request, but if it's no, tell me why and what do I need to do to improve my credit so I can get a yes later. So, I mean, those are very important things as far as getting that information of how you can improve your situation. Is it a cash flow situation? Is it something on my credit report? And what can I do to improve that situation? Also, having that ability to have the conversation we were talking about earlier, as far as, hey, what are the criteria you're using to make the credit decision when I ask for credit? That's very important, and understanding it in that way. Again, you can ask clarifying questions as far as when they say, well, it's your credit history, it's your credit score, it's your cash flow. You can ask clarifying questions and get guidance on that. So yeah, it's an important resource to build a relationship. Also understand what part that that individual banker that you're working with or lender, what is their part in the role? Do they take the information of the application, pass it to someone else to make the decision? Are they the decision maker? If someone else is the decision maker, again, asking those questions as far as what are the decision factors that are taken in is very important.
Right. I think that's something that is often maybe missed, that people are uncomfortable asking those kinds of detailed questions. But if you're able to build sort of a long-term relationship, then it makes it much more comfortable to ask those questions about who's having what part in your decision making for your credit.
That's exactly right.
Right. All right. So next, we're going to turn to this question about setting goals and checking your progress. So we can start with Rowan. What would you advise here around goal setting for credit?
Yeah, I think it is important. And what's great are there are, again, there's tools that can help with monitoring credit, um, which I think people should do. I don't necessarily have a specific frequency by which I tell people to check their credit. You should be aware of it, not just for credit score, but just to evaluate those credit reports to make sure that there's nothing on there that should not be on your credit report. We do hear of and have seen times where business owners have had things that they've either cleared up that still remain on the report, or things that they believe that they can dispute. So regardless, just being aware of what's going on in your credit history, past, current, and working towards that future strengthened credit score, I think is really important. And working towards, taking the things that have been shared with the business owner that can help improve their credit score, but also just the strength of the business, right? Because obviously credit is a portion of this, as Jack mentioned, but there's these other criteria, right, that come into play. In my work, as in the business coaching side, I work a lot with on the cash flow as one of those criteria for having access to capital, and what's driven and the driving forces between improving cash flow, which again is reducing expenses, which during this COVID period, I know that many business owners have been quite diligent at finding ways of reducing costs, anything that's non-essential, but also just thinking on the other side of increasing revenue in any way possible. So diversifying revenue by just widening that customer base, and also increasing your product and service offerings. Those sorts of things, just to try to improve your cash flow, is really important. And we try to share different things for businesses, thinking of what's shorter term, looking at short-term sales cycles to help improve revenue today, being willing to offer discounts, and just being a little bit more flexible with our relationships with customers. So finding ways to improve cash flow, reducing expenses, and one of the things to do to help, again, improve your position and being more credit worthy.
Right. I think those are all great goals to work toward. Anything else, Jack, you would add about this goal setting or moving forward with progress on your credit?
Yes, Rowan's getting me so excited being a banker and using some of those terms and what advice that he is giving. He mentioned cash budget. I was literally just on a call last hour about cash budgeting and helping our clients do that. That is so important. We went back a couple slides back. We talked about buying, making a decision strategic as far as borrowing, and we use the example of buying a piece of equipment. Well, when you make that decision to buy a piece of equipment, or you think you want to do that, maybe the first thing you look at is your profit and income statement from the last year or over a period of time. Well, does it show that I have the income and the ability to make a payment for what it's going to cost for me to buy this piece of equipment? But an income statement's over, a period of time, 12 months, 6 months. What Rowan's talking about as far as a cash budget, oftentimes we'll ask a borrower, or a borrower could be using something like a 90-day cash flow budget, or 13 weeks sometimes it's referred to, and that is actual cash budget. This is the money I'm starting with. This is where where the income is coming from. These are the expenses I got to pay each week, and literally week by week going through there and seeing what your ending cash balance will be each week. And do I hit a shortage? Do I have the ability to make the payments I have? So that's excellent as far as consulting advice as far as using a cash budget. A couple other things I would add there is, as far as your personal credit score, and from my own life, it's so important to make sure you make payments on time. And we all get busy. We travel, we forget. And just for my own self personally, on a lot of the credit cards I have that I use, I at least have them set up. It's been wonderful with technology over the years that at least I can set it up so there's a minimum payment being always made. Yes, I want to pay it off each month, and I'll go in and make a payment. But in case I would forget, that minimum payment's going to be made. It's not going to show late on my credit bureau. If you forget to make a payment, it could be 3 days later. Somebody pulls a credit report, and it'll show, hey, that you're past due on that account. By ensuring that a payment's made timely, that is a great way that just making sure that everything's taken care of and payments are made on time. Rowan also mentioned seeing what's on your credit report. There could be a collection account for a very small dollar amount that's out there that has been disputed, that you're working to get resolved. Sometimes think about how much of that collection account is. If it's a very small dollar amount, in the long term, just paying that small amount while you continue to maybe work to try to get that rebated to you or whatever, that it can make a huge difference. Some of those very small collection accounts, even though credit bureaus have lessened the amount of that impact it has on your credit score, it's something to think about. So those are just some of the additional points that I would say. Cash budget's important. Make sure your payments are on time. Anything that's out there that you can clean up, some small collection items or anything like that, I'd make that effort to do that.
Great. I think all of that is such good advice. It's really helpful. And we've prompted a lot of discussion in the chat box. We have lots of great questions coming in already, but I would encourage everybody to type in your questions into the chat box, and we will get to as many of them as we have time for with Jack and Rowan's expertise to guide us. So I'll go ahead and start with some of the questions that have already been typed in, but anybody else continue to type those in and we'll get to them. So our first question, just to kind of reiterate, you touched on this at the very beginning, Jack, but what is the difference and how can people think about the difference between a personal credit score and their business credit?
Great question. I didn't go in as deep on that. Your personal credit score has everything that you have done individually or jointly with another individual will be contained in your personal credit file. So if you're a sole proprietor and you are the business, if you have a credit card that you take out in your mind that's for the business purpose, but it's in your name, that would be in your credit file, your individual credit file. Your business credit report's a little bit different. Rowan mentioned that before. How you pay your suppliers. That information from suppliers is not being reported to a credit bureau. As a matter of fact, let's say you've set up an LLC for a company. That information is going to be reported under that LLC, or if you have an S corporation, that's where that information is going to be accumulated as far as how you're paying suppliers or any information about tax liens or anything will be under that entity's name, under the address at where you're at, and not on your individual credit bureau. There are some exceptions to that. There is a trend that as guarantors of businesses, more of that information may start flowing over to your personal credit report. In recent years, SBA, the Small Business Administration, a government entity on the federal level that helps small businesses, they have begun that they're requiring lenders to report information on individuals' credit reports as far as how they're paying on business loans that they are guaranteeing. So there is some trend that some of that information will start getting into individuals' credit report, but it's a very small amount of that at this point in time. But it brings up an important item. It's important how you pay your individual obligations and the ones that you're guaranteeing for your business. In small business situations, the vast majority, nearly 100% of them are guaranteed by the individual owner of that business because the bank wants that or the financial institution wants that as an additional source of repayment. So making those payments are important. There is such a thing as a business score for a business as well. One of the most common ones is called a small business scoring model. And what it will do is it'll combine the information that's in a business credit report that could be compiled by Accion or other entities. That's the information on the business and how they pay, but it also blends in the individual guarantor's credit score as well. So blended together, they'll come up in a model as far as a business score as well. And financial institutions use that business score as well. So there's a combination of scores out there. There's the individual credit score. There could be some type of score for the business as well that's being used. So both of them are out there. Making sure you're making your payments on time for each of those in timely manners are important. How's that, Meredith?
That's fantastic. It's really helpful. One just very quick follow-up with that, the small business credit scoring model, or we've got a couple folks in the chat talking about a Dun and Bradstreet score. Do you recommend going to maybe a specific website or a specific company to learn about that, or just seeing what your lender is using and measuring your business score against that?
I think you're exactly right. There again, getting back to that question, whoever you're working with, one or multiple lenders, understanding what they're using, and then your activities from there, I'd go accordingly. If they're saying they're using a report from Dun and Bradstreet versus Accion, hey, how can I get a copy of that report? What can I do to find out that information? I would gear my activities based upon the lending criteria.
Got it. That makes a lot of sense. All right, our next question, Rowan, I think that you've helped a lot of small business owners recently with this exact issue, so I think you're probably well positioned to answer this. We had someone in the chat who was unable to receive a PPP loan in the last couple months due to lack of documentation for their business. And so how can a business start to sort of formalize those documents or their business practices to be in a better position to hopefully borrow in the future?
Yeah, Meredith, absolutely. And, we definitely saw over the course of the last 2 months, we were working with thousands of business owners, and, some were positioned really well to apply, and others, just weren't in position yet to do so. So, looking forward, regardless if it's for programs similar or just for preparing yourself for any sort of opportunity from a loan standpoint, a contract standpoint, it's great to make sure that your books are in great shape. So maintaining strong financial bookkeeping is so critical. And it starts with making sure you have really good tools in place that are tracking all of that data, and making sure that you're recording and understanding what the information is as well. Being able to generate reports and understanding what those reports are actually sharing with you. The information that's in those reports is key. Common reports that are used in the loan application process, and other situations as well, include balance sheet, cash flow statement, and also profit and loss statements. So at a minimum, having understanding of what those are and being able to generate them quickly. Also, of course, tax reporting. Making sure that we are able to and are consistently filing our taxes is really important. And beyond loan products and grant opportunities, just in general, to make sure that we are staying compliant, not adding on additional expenses for being late for making tax payments, and when necessary, making sure that we're doing regular check-ins with our accounting professionals, our tax professionals. Leverage those resources to increase your own capacity, both for doing review, but also an opportunity to learn more about your business. So for anyone who perhaps has some challenged bookkeeping for 1, 2, multiple years, we highly recommend for business owners to consider, hiring somebody to help do that cleanup. You want to make sure that you have solid books as far back as possible so that you can maximize the opportunities. Often, you're going to need to show multiple years of revenue growth just to see how the business has been performing. So taking care of some of the cleanup is a good decision to make, but also going forward, making sure that we are maintaining solid books throughout the life of the business. It's the only way that we know how to inform a business owner to make decisions based off of how their business is actually performing. And that's something that your customers are going to know, partners are going to know, that a lender is going to want to know as well. So it's just a good best practice.
Great. I think that makes a ton of sense. I mean, it's also sort of logically follows that if you have a really good handle on your books and a really good understanding of where the money is coming in and going out, it would be easier to address any issue that might come in on your credit report because you would have those records and have a really good understanding yourself. So you might be able to dispute something or, keep yourself on track that way. So it would benefit the business and your credit score all at one time.
Absolutely.
Great. All right, the next question, we have sort of a series of detailed questions about credit score specifically. So Jack, I think you might be able to help us with these, and then Rowan, of course, if you have anything to add, we certainly welcome it. So have a couple questions about how exactly a credit score is calculated and what somebody can expect in terms of timing if they are to fix something on their credit report, pay off a bill in collections. When would their score go up or by how much? I mean, it's very hard to know sort of in general terms without the specific example, but can you provide any more detail on sort of the scoring models or how credit scores are affected by these different issues, positive or negative?
Sure. So you use the term scoring models. That is true. There is different scoring models that are out there that have been developed over the years. They continue to develop. Like the most recent scoring models penalize credit scores less for like a collection account from a cell phone provider or a medical collection account. So there is different models out there. So when you're talking to your lenders, you could even ask that credit score question because some financial institutions, they might use a particular scoring model on a mortgage loan, which might be different than a business loan, depending on how their systems are programmed and the information they're pulling. So there is different scoring models that are out there that are used, and then that could affect the score that they're looking for. But as far as the actual information that's used in that scoring, that's proprietary to the companies that are developing the scoring model. So even with the bankers, they won't tell us exactly what's all in and how mathematically those scores are calculated, but they'll give you general information as far as what is affecting those credit scores. So some general themes I would tell you is one, making your payments on time is important, and two, the recent information is more important than older information. So some information is dropped off after a certain number of years as far as if it's derogatory information. However, if you have a recent late payment, that's going to affect your score. A recent late payment in the last 90 days is going to affect your score more than the one that was a late payment, 2 years ago. So recent activity gets highly weighted, and so does as far as the payments being made on time. Other things that can impact it again are, collection accounts, liens. Rowan was mentioning making sure that your tax payments are made. Tax obligations are filed against the individual owners. So if you have something that's on there as far as a tax lien, either a state or federal ones, those would have a great amount of impact as far as your credit scores. So make payments on time. Current information will impact it greatly. The amount of debt that you are carrying will impact it as well. The larger amount of obligations that you're carrying in relation to the credit limit will impact it as well. So to give you an example, hey, I have 3 different credit cards. One has a limit of 5,000, another one has a limit of 10,000, another one has a limit of 15,000. If each of those have a balance that are very high to the maximum credit limit, that shows you have very little access to capital, additional borrowing on those cards. Being that there's a high usage on that will impact the score and make for a lower score as well. So we talked about current payments, how recent the activity is, whether it's positive or negative, and then the level of utilizations is some of the general themes.
That's super helpful to think through, sort of like 3 pillars of getting through the credit modeling. Rowan, anything to add on credit scoring?
I think that was fantastic. I'm over here taking notes as well. Just great advice, I think, for any of our business owners to follow. It was excellent.
That's awesome. Great. So we had another question sort of in this vein. I know that business owners who are really looking to improve their score, understand their score better, might be looking for access to information on it pretty quickly and pretty frequently. So I had a question about checking the credit score with programs such as Credit Karma, or NerdWallet has sort of an auto-generated score. I think that those types of inquiries, if they're soft credit pulls, are affect the credit differently than hard credit pulls. Am I right in that thinking, Jack?
That is correct. I mentioned that term before. A soft credit score is where a creditor or someone can access the information and all they get is the score for the individual. So there's no actual pulling of the credit file, where a hard pull, and every time we would get like a credit request at a financial institution, usually a lot of times we're going to go and do a hard pull. We're going to get the whole bureau. It'll have all the information on. It'll list all the creditors, how long that credit account's been open, what is the pay record on that, and then it will give a score. It'll also give the logic. So even though they haven't told us all the mathematics of why the score is what it is, it'll give us the logic of why the score is the way it is. It'll list out the factors. So we talked about delinquency being on there, high utilization. Those are the type of comments that will be down below that score that'll give us an indication of why the score is the way it is. If you're declined for a credit request and some of the reasons why it was declined is based upon your credit report, the lender should be providing to you the information of that on that adverse action notice of what was impacting the credit decision. And you could get something back that would say high utilization or prior delinquent credit history. And that information is being pulled off that credit report, and that is why the creditor is declining the request. They would have to share the information that impacted your score, that made them to make the decision not to approve the loan. If it's based upon the credit report, they have to share that information back as far as the factors that impacted that decision.
Got it. All right. So sort of the top line score at just a service, like a Credit Karma or a NerdWallet or something, doesn't affect your score, but it's that hard pull where they get all the information and all those details. But you should know about that before that happens. Your lender will be telling you they're doing that, right?
And you're exactly right. People are much more credit savvy than what they once were, and they'll get nervous about that, and rightfully so. If you would go and apply at 10 different lenders, and they each pull a hard credit pull on you, it only affects by a few points, but it adds up. I mean, if you got 5 different people or 10 different people pulling your credit report, that would have an impact as far as if they're all pulling a hard credit pull on it. If they pull a soft pull, it has no impact. You're right, Meredith.
Great. All right. Thank you. And then another question we've got here, Rowan, sort of goes to that strategy that we were talking about before. Somebody's asking about paying off some of the debt that they have to try to improve the credit score. And I think that we've talked about this in other webinars before too as well, but the strategy between I think it's sort of called the snowball or the avalanche method of paying off the biggest bill first or focusing on paying the smallest bill first. Rowan, do you have any advice about sort of how to pay off some of that outstanding debt?
Yeah, that's great. I love that analogy. And it's definitely. I mean, if you talk to 10 different credit coaches, you'll probably get 50-50 on which ones to tackle first. And some of that depends on the person as well. Sometimes you take on that small one, the smallest one first. It just gives you that quick win, that sense of accomplishment that kind of allows you to buy back some of your mental bandwidth, right? It's an accomplishment. It gives you confidence to go after the next one. What we often recommend either way is just looking at the cost of that capital. What are you paying in interest, and using that as part of your equation when you're deciding what to pay off. And then of course looking at your cash flow and deciding what can you afford at this time. Overall, regardless of which direction you take, the idea and the approach to pay down debt is excellent and something that we highly recommend. But of course, making sure that you still have enough cash to run your business, have enough in place so that you can take advantage of opportunities as they come around is also very important. So there is lots of benefits to paying off debt. And the discipline in place of constantly evaluating, what's your outstanding debt look like? What are you paying relative to what you're generating through the assets that you purchased the debt with? So, it's not necessarily a straightforward answer, but definitely like at the top of the list for me really is just constantly evaluating like the cost of that capital. So making sure that you're not paying more than you need to, and when possible, start to pay that down.
Mm-hmm. That makes sense for sure. So, Jack, anything to add on that question of sort of repayment strategy?
I think Rowan is dead on in everything he said. Looking at what the cost of the capital is, what you're being paid. There is, again, the smaller debts getting paid off, the mental wins from there, and balancing out that is very important. But where he came back again is, what can I afford to pay? That cash budget and how important it is to understand where your cash flow is, and what funds you have available. It comes back to that, how important that is.
Mm-hmm. Yeah, and that cash on hand can really come in handy, especially times like we're living through now with with everything being
Yeah.
so difficult. Which actually leads me to, I think that the question that'll have to be our last, given our timing. We have some folks who are wondering about the current situation, these times that are so much more economically difficult, so much more suddenly than anybody expected. And are there any relaxed considerations being given by banks or by credit bureaus or anything that's sort of taking into consideration this really difficult time? Or is it, I mean, it's difficult for the banks as well, so there might not be able to be some flexibility there. Any thoughts on that, Jack?
Yes, very challenging times for everyone. And, as far as additional consideration, I would say for our existing customers, we talked about building a relationship with a banker, and having that level of communication is very important, because where we're going to give consideration is to our existing customers and helping them determine their ability to repay us. Most financial institutions, we have owners that we're answering to, whether they're our shareholders or owners of the company, whoever's providing the capital of that financial institution. We have to rate those assets and determine the ability for someone to repay us who has a loan with us right now. And obviously that's very challenging right now. The answer sometimes is I really don't know yet. As things develop, I'll have a better idea. So what I'll tell you that is, borrowing money now, I would say in general, is probably going to be more difficult than what it was 6 months ago, because each lender is going to be looking at each transaction more carefully because of the challenging situation we are in now. And each lender probably has some assets on the books as far as loans that they're making now, that the possible losses they're looking on loans they have previously made is probably greater than what they were looking at 6 months ago. Rowan mentioned something before which is very important. He mentioned about having current financial statements. It's so important right now because, what you did last year in 2019 might not have a real good indication as far as what you're doing right now. So being able to produce financial statements of what has happened over the last 60 days or 30 days or last 90 days is very important to help the financial institution make a determination as far as what they can do.
Yes, definitely. Rowan, anything to add, just because Accion is a little bit of a different kind of financial institution from a traditional bank? Anything that's sort of more flexible, or anything that you've seen being offered sort of to accommodate for how difficult things are right now for businesses?
Yeah, it all aligns with what Jack was saying as far as that relationship. So we too are looking at our current customers, right, and saying how can we help them during this situation, during this time period. And we started off with offering right away, just offering reduced payments for anyone who is an existing borrower, through the month of February, and we've extended that since. So I would say, if you're not sure, have that conversation with your lender. Have that conversation, see what they are offering, and see in what ways that they are able to work with you with your existing loan. It is challenging for all parties involved, but really just again, knowledge, gaining that information, and then being prepared to provide details to your bank in ways of creating the best action steps and the most flexibility is what can be done right now.
Absolutely. All right. Well, thank you so much. Thank you, Rowan and Jack, for all of your advice today, all of this fantastic expertise. I think it's really valuable for everybody, but especially business owners right now, to understand these concepts a lot better and kind of protect or build our credit. So I appreciate your time. Thank you to everybody who joined us today for this conversation and asked questions and participated. I will be sending a recording of this discussion out later this afternoon, so you can refer back to it at a later time. And I hope you join us for our last webinar in this series next week on June 25th. So we will see you again next week. Thanks, everybody. Have a good day.
Thank you.